Hey, we are live, kind of. Welcome to Money Monday. Money Monday, Money Monday. Shawn and Lacey here with you. Thanks for jumping on the live transmission today. So much going on in the world. We're super happy to be with you on this live transmission. We do need, in full disclosure, to let you know we're not
actually in the studio.
live. We are in the studio. We're not
No,
live.
not this moment.
Oh, but I'm
The
in
moment you're watching?
No, I am in the studio this moment.
No, this moment. The moment they're watching, I said.
Oh, the moment
That
they're
moment,
watching.
That moment. This moment is
moment,
this
we're
moment that
in
they're
the studio.
watching.
In that moment.
In that moment.
When we teleport to that moment in the future.
Which would be this moment.
We would be in Mexico.
We are in Mexico.
We are right now. We are in
Mexico.
Mexico City, organizing our outreach program through the art of the specific, attending to people of Mexico, population of Mexico who do not have access to chiropractic care. Now there is chiropractic care in Mexico, but you gotta have pesos to access this. So as part of a humanitarian effort, we are leading a group of doctors in Mexico City, Cuajimapa, and delivering chiropractic care. Hey, make sure that you jump on our social channels. Find us on Facebook, on Instagram. We're easy to find. Super easy to find.
And this
isn't
Mexico like we're at the beach
not
hanging
Cancun.
out. Cancun,
no, it's not Cancun.
beautiful
Mexico
waters.
City.
No, it's raining. It's storming. That's what the weather says it's going to be. It's going to be in the 60s. I'm going to be wearing a jacket and pants.
You are wearing a jacket and pants. You can't say you're going to be. You are.
I am in this moment wearing a jacket and pants.
Thanks for jumping on, everybody. Make sure that you subscribe to the feed. I need for you to do, you know what to do. I need for you to click that notifications button, and I need for you to share the transmission. Share the link for this live transmission on your social channels. Even though we are not live right now, we're going to be bringing on live guests here in just a second, and they will be live. They're even going to be doing a Q&A. And in addition, we are still giving away, because we're committed to you. We committed to this every single Monday. We just didn't know how to figure it out logistically from Mexico. We totally would have done it from Mexico, but we were scared. We were scared. And so we're doing it here live in tape and then live again, if that makes sense. But we're giving away $300 tonight. Call your friends. The drum, as you call it, Lacey, the canasta is full of names of the Black Diamond Club members. If you want to get your name inside the drum, all you got to do is go to www.blackdiamondclub.com.
James will be here. James is here. Names.
James is pulling names tonight.
We're pulling names.
3 names, and we're giving away $300 cash.
We have had so many winners. We had anticipated that when we were going to do this, it would build up $400, $500, $600, $700. But no, you guys are winners. Everybody's winning.
Everybody's showing up live, which is great.
It's fantastic.
That's why you've got to subscribe to the channel. You've got to turn on notifications. Join Black Diamond Club. Get registered for Marketing Matters coming up November 3rd and 4th in the Fountain Blue in Miami. Amazing program that we have there. But most importantly, you need to get registered for our last 5 moves. Listen, the clock is ticking. We are about to close registrations for our last 5 moves. So many people are registering. We are literally going to break down. We've given this a lot of thought. We've been talking about this for a long time. We've been prepping it for a long time. Over 5 consecutive days for 1 hour, Lacey and I are going to be delivering the last 5 moves that we attribute our success to, and teaching you how you can apply those moves in your business. And if you elect for that VIP option, we come on an hour early every time. You might as well get it.
For all the Q&A
we're going to be there,
need.
and we're going to be live answering Q&A for you. So make sure that you jump on that. Go to www.ourlast5moves.com. And when we run this, I don't know if we can throw up the sound effects and the time. It's going to be popping up all over the place. Ourlast5moves.com. So here's what we're going to do today. At the time that we are setting this front end curtain, giving people some time to roll in, giving people time to share, to subscribe, to comment, get everybody in your seats, get your popcorn ready, because this is a very special transmission. We're going to be bringing on here very shortly Eric and Isaac. That sounds like a morning show.
Yeah.
The Morning Drive.
Welcome
with
to Eric and Isaac in the morning.
Money Mondays with Eric and Isaac. So Eric and Isaac are going to be jumping on. Eric is someone who has worked. Eric and Isaac both have worked with us, so they are trusted advisors to both of us relative to investment deals. So they are the people that we have vet our investment deals, because here's the importance of this. And I've had people that when I've had them vet deals actually comment to me like, "Hey, that's smart." People have said to me like, "Who's Eric and Isaac?" And I was like, "Look, here's what I do.
These are my guys.
I have them vet deals because obviously when I see deals, and especially because I am a relationship capitalist, I get tied in emotionally to the deal. I'm like, oh, this is great because I like that person and it'll be so great to work with them.
And you get really excited about the potential ROI and all the opportunities.
Well, you're more just emotionally invested, but you're not numbers invested. And so Eric and Isaac come along and they're able to run down the numbers and give me great advice, because they don't care about that person most of the time. They don't, not that they're not sympathetic or apathetic, but they don't know them. I've just said, hey, well, you take a look at this. And what's also great about them is the majority of the time they tell me this is a bad idea.
Yes, which we need,
which
right?
You need. All of you, otherwise, you need an Eric and Isaac in your life.
We say that all the time. To most everybody, everything looks like an opportunity, because most people that are selling you opportunities sell it really well.
Yep. So Eric and Isaac are jumping on here. The important thing, too, is they're going to be talking about the latest advances or the happenings in our economy, letting you know what that means to you. And they're also, check this out, they are also agreed to do Q&A. So they're going to be watching that feed. Let's fire up your questions.
This is an actual opportunity for all of you. Being able to ask them
these guys get paid big money to give advice. They're going to jump on here. Again, they're very benevolent people, just like us. They want to help, just like us. They're a perfect fit. You're going to absolutely enjoy your time. You're going to be edified. You're going to be so happy to receive this information. Everybody buckle up. Here comes Monday Night Drive with Eric and Isaac.
All right. James, we good?
You guys are good.
All right. Thanks. Well, good evening, everybody. Obviously, good introduction from Shawn. This is the first time getting to see that. So, Shawn and Lacey, appreciate you guys. And thanks for all you're doing down in Mexico as well. Here with me is Isaac Bennett. We'll get to him in just a minute. But before we do, I want to hit on something special about Shawn and Lacey and what they're doing. If you got a chance to listen to their podcast earlier today, they talked about a couple different things that are so perfect for this show tonight. Isaac was actually asking me as we were prepping for this. He said, "What are Shawn and Lacey about? Help me understand what's the purpose of this podcast. What's the purpose of BDC?" And obviously on the surface, it seems like it's a lot to do with making money. But I got into the real purpose, which was bringing chiropractic to the world, because they know the power that brings, and that so many of you guys in BDC Nation understand. So fitting that we'd had that conversation, and then later that afternoon, I was listening to the podcast and heard them talk about that. A couple of the big things that Shawn mentioned on there was that he's got the stigma that they're all about the money. Shawn and Lacey are all about the money. That's what BDC is all about. But obviously they hit on that in the intro video. That's not it. But he also says, in order to give, you have to have. And so this tonight, what we do with financial planning, with investments, is not to give so you can to just have your own wealth and sit on it and be greedy. It's so you can do something with it. Wealth is a tool. Money is a tool. Most of you understand that. But anyways, just applaud Shawn and Lacey for what they're doing. Appreciate what they have built inside BDC, and hope that as we roll through this tonight, that the rest of you can kind of understand. We want to help you build wealth. We want to help you build security, but also so that you can use it for whatever your call and your purpose is. That said, welcome to Money Monday. A lot of you know me. Those of you who don't, I'm Eric Scoville. I am a financial advisor with a big emphasis on alternative investments and tax planning, financial planning. And with me here tonight, we're very happy to have Isaac Bennett. He's a business partner of mine. Isaac, you want to give a quick intro?
I'm not sure I do want to give a quick intro after Shawn and Lacey setting us up that way. I'm pretty sure I'm going to fail with all the nice things that they said, but I appreciate it anyway. So just to clarify, Eric makes big money giving advice. I make big money doing real estate. So just for the record, but no, it is an absolute pleasure to be here with you guys tonight. I feel a tremendous honor to be here. And I just want to echo what Eric said about Shawn and Lacey and about the mission behind what we do. Our firm, very briefly, is called UR. The premise behind UR is that you can't lift somebody up or exhort them without first saying you are. And it comes from always telling my 5-year-old niece, Collins, you are so beautiful. And so we really, truly believe that both in business and both in philanthropy as well. We do give 20% of our net income to charitable and missional causes. So that's what UR is. And from there, we'll do our best to live up to Shawn and Lacey's just incredible hosting here. It's nice to meet everybody.
All right. Yeah, Isaac's had a bit of a rundown on what BDC is over the last year or so, and especially after his brother-in-law, Isaac Schaefer, which many of you met in Phoenix, came down and got to experience what the BDC family is like firsthand. So quick disclaimer here. I am a financial advisor, and I do give financial advice, but this financial advice may or may not be suited for you. So take it with a grain of salt there. Certainly consult your financial advisor or talk to me separately about this. So getting started tonight, I asked Shawn, what does he want to talk about? What should we cover here? Obviously, there's a wide range of things that we cover with clients. And if we've got this much face time with the group, how do we best serve? And so part of what that is going to be the Q&A that Shawn referenced. So we are going to be watching the chat. So please put some questions in there. James is going to be all over that, trying to highlight the questions that seem like they're going to be most fitting for a large group of people, and we will get to those. We're going to try to keep the content into that normal 45-minute window that Shawn and Lacey do. But if we run long with questions, Isaac and I have both cleared it with our wives to stay on a little bit later and keep answering questions there. So keep the questions coming. If we don't get to it right away, maybe throw it back in there again, and hopefully we'll catch it. But the big thing that Shawn started with was to say, go ahead and start on alternative investments. And for those of you who have spent enough time around any of the, anything that Quest 7's doing, you understand that Shawn is a big proponent of alternative investments. And what an alternative investment, actually, this is more of an interview. So Isaac, why don't you tell us a little bit about what your definition of an alternative investment is?
Well, I think it's pretty much anything that Eric wouldn't sell as a financial advisor, maybe. So we like to say that
standard financial advisor would not sell.
Fair.
Clarify.
So yeah, we don't have any experience with our daily drive show here, so we're going to probably banter a little bit. But I think that the critical thing is that these are investments that you're not going to find with a traditional financial planner or advisor. They're alternative in the sense that we're generally using Regulation D carve-outs to provide private placements within the bounds of the law, of course. And they're non-paper investments. So it could be anything from a real estate deal all the way to maybe a venture type deal like Pringle Robotics, which many of you are familiar with. So we really run the gamut. So when we say alternative, it's not like we're only investing in pot stocks or something. We're certainly all across the board with what we mean. It's non-paper investments.
All right. Thank you very much for that. So from here, then, as we cover that, we'll try to hit a little bit of explaining, what some options are for you, as well as maybe how to fill out a portfolio with that. What a lot of people inside BDC have become familiar with is the barbell approach. And so barbell approach says you're going to take a slice of your investments over here, turn my fingers the right way for the camera, that you're going to have a slice of your investments over here that are going to be very aggressive. These are things that we are hoping to hit more than singles. We're going for doubles, triples, home runs, and grand slams over here on a small portion of the portfolio. And then over here on the other side, you've got get my cameras right there. You've got a much larger portion of conservative investments. And the conservative investments are something that you can count on to be more stable, to not get hit hard when it comes to any type of bubble in the stock market, dip in the economy, that you're counting on that to be a much more stable source of either income or holding its value. And so that way you can count on, you're not going to hit a home run on all of those, the aggressive side, but you're going to get, you're hopefully going to get a couple hits over there that have some substantial gains, which would offset the gains that you would expect to get from a standard stock market portfolio that's trying to get that 8 to 10% a year, year over year. There's something to make sure that we talk about within that is liquidity. A lot of the alternative investments don't provide much liquidity or hardly any. They often do provide much more cash flow than a standard stock would. And so with all of this, it all needs to be assessed. And it's not that you say you have 100% of it allocated just between risky investments and ultra conservative investments. It's not that. It's really kind of figuring out what is that right fit for you, and how do you position your funds to be able to adjust with life as it changes. But Isaac, anything to throw in on that?
I'm just seeing a bunch of questions coming in the chat, and first of all, thank you. They're fantastic questions. I think that this one that actually I think James just threw up about a suggested ratio of stable to more risky. One of the things that you hear financial advisors talk about all the time is a 60-40 stock and bond portfolio. And I'm here to tell you that that is a really good way to lose a lot of money over the next 10 years. So we look at things a little differently. The way I look at them is by position sizing and understanding how big of a position that it relates to in your overall portfolio, any individual investment. And then also thinking about what your risk or your odds are of losing a percent or all of that investment and how much that would affect your overall portfolio. So for my own account, for every investment that I make, I actually use a formula that is called risk-adjusted beta, of where I am trying to understand, if this goes poorly, how much will this affect our overall portfolio? So that is a very specific question that gets into your own situation, your own really risk tolerance and other things. And I would highly encourage you to work with Eric individually on that question, and then he can give you specific advice regarding that. But I will tell you, position sizing is the single most important thing that you can get really good at in your own portfolio. So it's a great question.
Yeah. Yep. Thanks for that, Isaac. A couple other questions in here about 401ks and real estate. The idea of, if the market's down, should you sell out of your 401k? There's a strong camp that says that, hey, we're probably going to go through a very tough decade for the stock market. But there's also all of history to tell you that you're probably, if this is long-term money, that you might be best to stay the course and not sell an investment when it's down. It really gets into a much more personal discussion of risk tolerance and, what Lacey mentioned a long time ago, risk tolerance and risk appetite, time frame on this, what you need from a liquidity standpoint, what you might need from how soon you might need access to the funds as well. So more to it than that to decide, hey, do I move all my 401k to cash? I would certainly not make that recommendation. I certainly do agree that it's probably good to have some stable position inside your investment account that you could use if you needed it. The other question in here was about real estate and inside your 401k. And that's probably, again, a longer discussion, but yes, you can invest money from your 401k, not from your 401k, into real estate outside of what's called a REIT, a real estate investment fund, or some other type of stock ticker type symbol that you could that is invested in real estate. But if you wanted to actually invest into a piece of property that you want to go purchase yourself, that would be done through a self-directed IRA. You cannot use a 401k for that, but once it moves from a 401k to an IRA, you can use the self-directed IRA for that. There's funds like Millennium or Midland Trust that offer those services. So maybe move into the next piece of this, which is we're going to talk a little bit about, we're going to talk about real estate. We've got a real estate deal that we are in the process of, we're about to bring to our investor base. And it's a few of you have already seen this, but it's a really good baseline for you to understand how to vet a real estate deal and what you might compare other options to. So when you're looking at whether it's a stock, whether it's a piece of property you're going to go purchase yourself, or whether you're looking at some other, Pringle or Pringle Robotics or something else like that. Everything should be kind of measured with what Isaac's talking about of this. He's got his way of calculating risk. There's a unit of risk for the unit of reward that we're trying to gain here. And so everything should kind of be vetted with that. So when we look at this one's going to be on the conservative side of the barbell. This is something that is much more down the middle of the fairway from an investment standpoint of real estate and what you're looking for stability. And so we're going to go into that. There are some tax advantages that come with this, and it's a really important piece. You've heard throughout BDC, Dan Nicholson really talked about this a lot. I know Shawn's talked about this a lot. Dave Allred also hit on this in Phoenix. But understanding real estate professional status and understanding what happens inside active income versus passive income. Isaac, you want to maybe hit just a little bit on that?
Yeah, just very briefly. So if you can qualify as a real estate professional, or reps for short, you can take depreciation losses from real estate, which is one of the big reasons to invest in it, and write them off against your active income. If you are not a real estate professional, you cannot write them off against your active income. You can only write them off against your passive or capital gains. And so it's somewhat critical for the strategy to be able to write them off against it. We don't want to get into the nitty-gritty tonight of what it takes to qualify as reps, but we do have 2 links from accountants that we trust that certainly could help you have a primer on what it actually takes to qualify for reps. One quick thing to note: if you are married and your partner has status and you file together, it only takes one of the 2 of you to qualify for your filing status. So that's a way that a lot of people around actually get their rep status, is one or the other of the married couple will qualify and allow you to have active write-offs on your taxes. So for anybody that's a high earner in this group, W-2 or self-employed, it's a critical piece of the strategy to get.
Yep, absolutely. All right. So let's get into a little bit of the San Antonio deal. So San Antonio is a real estate deal that we're going to be bringing to our investor base. It's not an official BDC sanctioned investment, but we are going to be bringing it to our investor base. So Isaac, will you maybe go ahead and start just giving an overview of it? I might cut in with a couple of questions here and there, but we just kind of give a bigger overview of what a real estate deal like this looks like, and a little bit of what an investor might experience here.
Yeah, great question, Eric. And if you're okay, I'd like to talk conceptually about real estate investing first, if I may, because I think this is critical.
Yep.
I've been investing in real estate since I was 22. It's been a long time, and I've found really one thing to be true, which is that I know a good deal when I see it, and a good operator. I'm not necessarily a good operator myself. And this is just about like anything, where most people who are buying real estate should not be doing it themselves. And, I had a really good, I think, conversation with Skip and Julie Weiss about this. Many of you probably know them, I would guess. And just about the difference between hiring great operators and doing it yourself. And I think so many people get caught up into the trap, not necessarily saying Skip and Julie, this is just what reminded me of it. We were talking about it. So many people get caught into the trap of thinking, I'm going to jump into that game. I'm going to do this. Well, the reality is it's just like anything else, where there are professional, all-star, superstar, world-class operators, and then there's everybody else in this. Just like chiropractor, just like a dentist, just like any other industry, there are absolute sharks that do this, and everybody else is a minnow. And so what I realized about 5 years ago is I shouldn't be operating, because I'm only an average operator, and there's other people that are way, way better at it. So we went down this journey of saying we need to build out an operator network of people who are the Michael Jordan of real estate operating, and we need to become friends with them. We need to become partners with them. So that's what we spent the last 5 years doing, is really creating this idea that says we want to bring big checks to the best people and let them do it. And another thing that I found is that trips a lot of people up is a lot of people get really, really stuffy about the percent equity split. And I will tell you that there are people who could offer me 99% equity in a deal, and I would say no matter how much money it was, because I know that they're still going to lose money or not make very much money. And there are other people who could offer me 10% in a deal, and I'd give them whatever it took to get involved with them, because they're that much better. So when we look at Thank you for that great question, Jessica. Operating, yes. Day-to-day operations, acquiring property, renovating property, leasing property, property management, taxes, positioning, disposition, all of the other things that go along with running or operating a property. So this would be a professional output, would do everything. Really, real estate's about 5 different businesses in one, and most people are good at 1 or 2 of them. So just keep that in mind. So when we talk about a specific deal, we have hand-chosen partners to do this with, blood, sweat, and tears, and about 13 years of experience in real estate to find the right partners to do this with. And we pay them handsomely to do it because we know that they will preserve our capital. They won't break rule number 1, which is don't lose money. We know they've underwritten the deal incredibly well, and we know that there's a ton of upside in the deal. And so I think if you're okay with it, Eric, I'll just go right into San Antonio and what we like about that one.
Yeah.
We are working with our preferred partner, REM Capital, on this one. They have an advantageous structure for limited partners, which is what we would be coming in at along with the group. I should clarify in that we invest our own money into every deal that we do first. What we do is we bring groups of people together to do larger deals and get advantage terms with these operators. And so this particular deal that we're looking at in San Antonio, we were there with Skip and Julie last week.
What is a limited partner?
A limited partner is somebody that brings nothing but equity to a deal. Okay,
and what risk do they have?
They risk the money that they put in the deal and really nothing else. There's no physical liability. There's no financial liability if a deal happened to go south. So really, a limited partner is in a heavily advantaged position to a general partner because they don't have the financial risk in the deal other than their own capital.
Thanks.
Now, these can come in all shapes and sizes. The great thing about a partnership is you can do anything you want with it. The bad thing about a partnership is you can do anything you want with it. So you have to understand the ins and outs of these deals very, very thoroughly. The tax code, the legal, everything. But this particular partner, Robert Ritzenthaler, he is such a symbiotic thinker with us. This is somebody that I would trust my future children with. This is a really, really good person. And they do about $500 million in real estate per year. So they're a big time player. And he is offering us advantage terms. We basically get 10% more equity than you would get on your own because we come as a group. We don't charge any fees at all. So this is a highly advantaged way to invest. The particular asset that we're talking about today is in the heart of San Antonio. San Antonio, why is San Antonio interesting? Well, it doesn't get anywhere near the press that Dallas-Fort Worth gets, or certainly Austin, but it's growing just as fast. And so if you think about sort of deals that can still cash flow in areas that are really growing, San Antonio is right in that sweet spot. So Robert's group has found a deal that's 304 units right in the middle of San Antonio. This is C+ or B- class property. What does that mean? We probably don't have time to clarify it tonight, but it's the sweet spot for value add while still cash flowing. I'm happy to answer any questions afterwards, by the way. So why is this deal attractive? Here is why. When you look at these properties, you want to know, are we buying it right? Is it a good location? Is it durable? Will it last for a long time? And what is the upside per door, both as it sits and with better management and renovation? This particular asset is being bought for about $92,000 per door, which is very good in that market. Very, very good. It's about 50% below average price. And this is an average property as it sits. But the upside here is that the rents that are currently being charged on average without renovation are between $400 and $500 below market. With renovation, they're between $550 and $700 below market. It doesn't sound that interesting until you start thinking about the math. Here's the math, and this is where it gets really important, and this is the most critical thing to know about commercial real estate. The math on this is $500 times 304 doors times 12 months divided by a cap rate, and that cap rate on an asset like this is about 4.5. So the math there is 500 times 12 times 304 divided by 0.045. If any of you have a calculator and you're playing along at home, I'll let you do the math yourself, but it's over $30 million of upside in this property. What's the purchase price on this property? It's $29 million. There you go. I just showed you how there's about 120% upside just in regular renovation and better management. That's a professional operator. They'll knock this business plan out in 18 months. Me, it would take me 3 years, and I'd probably get half of that upside. That's why we pay the best to do it, because the velocity of their money is so much faster than non-pros. I'll pay that guy to manage my money all day long.
And how picky are they about the deals that they choose?
Well, to give you an idea, he's from Orlando, and he's from like the Tampa St. Pete area, and he has underwritten over 100 deals in Florida. He's made offers on over 100, and he's only just now under contract on his first deal in Florida. So that probably 1 in 4 or 500 in a normal location, because he's not going to underwrite unless he thinks he likes it. So they are incredibly picky, and it's also why they don't miss. I have never seen him underperform a pro forma. So he's going to come out and say, hey, this is going to do 16 to 19% IRR, internal rate of return. And I've never seen him underperform what he puts on there. He underwrites extremely conservatively, and he returns money to investors very quickly.
There you go. Thanks, James. All right. Let's get into a few deal specific things about this one. What does it look like for an investor? What are the terms here? Can anyone invest into this?
Yes. So a couple of things that we do is Robert's minimum is $100,000, and we think that's a little bit tall. There are some people who diversify a little bit more, or maybe has just become accredited and doesn't want to put 10% of their portfolio in a deal. Totally understand that. So when we bring a group, we actually lower that minimum to $50,000. And like I said, we don't charge any fees. So deal specifics on this, the limited partners, which we are, our group is, they get the first 8% of all earnings, cash flow, equity, et cetera, upon disposition. So highly advantaged for LPs. You get the first 8% no matter what happens of all earnings, which is great. After that, typically Robert's deals are 50-50. 50% equity to LPs, 50% to GPs. That's not the highest split you can get. This is very intentional. Like I said earlier, I will pay the right operator for a lower split because I know they're going to return our money with some friends. With us, he gives us an advantage term, and we get 55% that we pass on to the investors. So 55-45 is our split, which is a 10% delta between what Robert offers a regular investor. So $50,000 minimum, 8% preferred return, meaning you get the first 8%, the LPs do, and then 55% of the equity in the deal for limited partners. So we think it is just an amazing setup for limited partners. This pays every month. So basically the second month that you're in this, you start getting a paycheck every single month, and it is the definition of mailbox money. This is truly passive investing. And I don't say that lightly, because real estate is the opposite of passive investing. It's incredibly active, but this is a way to do it truly passively. What else would you like to know, Eric? I'm rambling. I'm sorry.
No. This is good. Let's hit on a couple different things. So first one is, does that 55-45 split happen for the life of this property?
It sure does. So here's the way this works. Generally, Robert is trying to effectuate a deal strategy over a 5-year term. Now, he is a long-term investor. He looks at real estate the same way we do, which is not that selling is a business plan. Selling is not a business plan, and you should be careful with anybody that looks at it that way. Selling is an opportunity that the market provides you. Okay,
when you say selling, you mean we're going to buy a property and turn around and sell it?
Disposition, absolutely. It's not a business plan, right? It's speculating. And some people are very good at that speculation. Truly, they are. And so, some people make money flip after flip after flip. Hard business. And you don't actually get the real value of real estate, which is compound returns over time. And the nature of buying an asset with a fixed monetary base today, which is the debt that you put on a property that grows in rents long term. That's the value of real estate, and as well as many other things. I do not flip properties. I do not think it's a good business. I think it's a bad business, in fact, a very hard one. Robert believes in the same thing. And so when you look at this, his business plan is to pay you back all of your money in 24 months by elevating the net operating income on a building, refinancing it, getting enough money to pay all the LPs back, the limited partners, that's us, pay the limited partners back their money. So you're in the deal for nothing at that point. Actually, you're in the deal. You've already made money on your preferred return. So you're in the deal for positive. And critically, you keep your equity for the life of the deal. So at that point, you're going to be getting paid every month until if he happens to sell it, and you're going to have all of your money back in that deal. We don't think there's a better way to I don't think there's a better way to invest, period. The other thing that's exciting about this is, of course, when Robert if he does sell a deal, and he does occasionally sell if the market pays him some stupid multiple, he 1031s every time, which means that your capital is going to go into a larger deal, which you will not pay any depreciation recapture on. That's another critical thing about real estate.
What is a 1031?
A 1031 is just the section of the tax code that allows you to sell a property that has been depreciated. So you're taking your basis and then depreciating it over time. And then when you sell that, that's what you would be paying taxes on. But a 1031 allows you to actually step up that basis to the price, the cost of the new property that you're doing. It's a legal term that actually has a specific set of rules that you have to follow. But what you need to know is your operator partner, are they conscious of this? Are they aware of this? And are they taking advantage of this part of the tax code? And I can tell you, in Robert's case, he's absolutely taking advantage of the tax code. And that is incredibly important because it's so tax advantage. This is the only way to make real income without paying taxes. There's a few other very nuanced ways. This is by far the easiest and best way to do it.
Thank you. And then one last question on this one, and then we'll move on here. What are the tax advantages inside this deal?
The tax advantages are this, and this goes full circle all the way back to our first conversation about real estate professional status. This deal particularly, let's use really round numbers for easier. It's actually a $28 million purchase, but let's use $30 million for the sake of the math because I'm not that good at it. So let's say this deal was $30 million. We are going to be doing what is called a cost segregation on this, which basically means you can actually segregate on an accelerated depreciation schedule everything that is not structural in nature. So you're talking fixtures, appliances, lighting, et cetera, et cetera, et cetera, et cetera. On a deal like this, I would expect that we could get between 30 and 40% accelerated depreciation, and that's on the price of the deal. So we may see you're going to see a 60 to 70% write-off in year one on your investment. So you personally, let's use $100,000 as a recommendation. And I'm overselling this. I know it sounds like I'm overselling this. Every word of this is directly down the fairway, exactly as it happens. Let's say you get a $60,000 write-off on your $100,000 investment in year one because we are using the accelerated depreciation carve-out on the tax code via a cost segregation analysis. It's about a $10,000 thing that we do. And you'll get a huge write-off in day one. Now, it's critical to understand that write-off is a passive write-off for non-real estate professionals. Okay, so if you do not qualify as a real estate professional, you can only write that off against gains you've got in your equity, maybe your stock portfolio or capital gains or something of that nature. You cannot write it off against W-2 or earned income via your business. However, if you or your spouse qualifies for real estate professional status, you can write it off against your active income, meaning against your W-2 or your earned income through your business. Did I answer your question, Eric?
You did. And just one clarification for everyone is you can write that off if you have the long-term version of real estate professional status. If you only have the short-term version, which is 100 hours, then you need, and with a lot of stipulations behind that, then this would not give you a write-off against your active income here because this is a long-term rental.
Read those two links. They will clarify exactly what we're talking about. It's pretty nuanced, but it's definitely something you should understand in the tax code. It's very powerful.
Okay, so we'll try to make sure, and the whole purpose of this is not to be a shameless plug for the stuff that we have going here. It's just the idea of these are things that are outside the norm of what a standard financial planner is going to be talking about, a standard investment advisor, whatever the term they're calling themselves. They're not getting into these things. And so, the normal conservative side of that barbell is that's a bond. Those are bonds, cash, gold, that type of thing. And so getting into something like this that's going to kick out returns that honestly, as a financial advisor, I'm hoping that my stock portfolios kick out. But now we're doing this on the conservative side of that's where the big advantage is, plus the taxes, the tax benefits as well. So there's a tremendous upside to this, and it's important that you just start to look at how does real estate fit into this. Active real estate versus passive real estate. This is passive. You just put the money in and you don't do anything else with it. There's all sorts of advantages to doing active real estate, that you're going to do yourself, whether you're doing single family, long-term rental, short-term rental. You're starting to get into some multifamily stuff. The bigger the property, the more complexity and the more dangerous it is for you as an individual to operate. There's just a lot more risk on that side, but you can definitely go that route as well. So tax advantages are out there, good returns are out there. So much emphasis needs to be put on the acquisition of the property, the purchase price, and the operator, and that's where we have just decided it's so much better for us to partner with really high quality operators. So maybe last thing, so how would if someone wants to invest into this one, how would they go about that?
Yeah, so we're just putting together our own special purpose vehicle, which is a fancy way of saying our own entity, like an LLC, where we all come together and do it. I want to address Anita's question here. How many limited and general partners? The general partners vary on each deal with REM. Here's how we get paid on this, by the way. Just I want to disclose this for sure. REM gives us a small piece of the general partnership as well to do this. So they're offering us advantage terms, and then we're a small piece of the general partner. The only general partners are REM and us. So we're basically the financial guarantors of these deals. And so I say that's generally true. Occasionally they'll bring on a third general partner, but it's really Robert and me is who's doing it. Limited partners, it's really a dollar figure, not a quantity of limited partners that we would take. On this particular one, we can raise up to 10 million on this deal. And so theoretically at 100,000 per, there could be 100 investors, but normally many people come in for more than 100,000. So there's never that many. Call it between 30 and 40 typically is what we will have on something like this.
Okay. All right. Well, let's move on to some other pieces of the barbell here on the aggressive side. And again, we're gonna take some time and do some more questions here as well. But we wanted to give you an update on what's going on inside some of the other alternatives that we have brought to the group. It's our first time to really talk to the whole group about this in a while. So, Isaac, we maybe give a brief update on what's going on inside Pringle Robotics.
Oh, Pringle Robotics is... I'm smiling because I had probably the most incredible call of my professional career today between Sudhir Saja, the founder, and a gentleman who's very much like Sudhir in AI. And I just sat there with my mouth shut for an hour because they were talking like it was 2035. And I'm just like, what are they even talking about? So, guys, the story there is unbelievable. They've crossed 7,000 bots in service. They have been approached by both SoftBank and Segway in the past 2 weeks to utilize their platform to build those companies' commercial robotics. And the sky is just the absolute limit with what is happening here. And so updates-wise, sales are going great. It's a business that's growing like crazy, so it's very difficult, of course. But I've never seen a story quite like it, and I can tell you that people desperately want to be on board with this one. So we're very excited. I think that from a partnership standpoint, it's going well. We're closing this raise here in the next couple of weeks. There is still a little bit of room in it if anybody wants either a piece or a bigger piece of it as well. But I think it's just it's an opportunity that you almost never see in private markets. You see them in public markets, but it's normally way farther down the path of progress. And so we're excited. Couldn't be more thrilled to be partnered with them. Again, full disclosure, we don't get paid for that deal at all. We just took some equity in the company for Pringle, and so we only get paid if they do really, really well. So to me, it doesn't matter that much if you invest. It's excited to have people along with it because it's really fun.
Couple notes on that. So this one would be on the aggressive side of the barbell, but it'd be toward the conservative side of the aggressive side, just because it's a bigger, more stable company. We'll talk about the Flammic or Moon Gloves, as Shawn has dubbed them. which would be all the way to the extreme side of the risk spectrum. But this one, with the size of the company already, with the reoccurring revenue that they already have, this would be on the more conservative side of the aggressive portion of this. And as from an investment standpoint, the minimum here is 200,000. This is time for a good plug for Quest 7 here. When you do what Shawn has done inside Quest 7, you get access to these deals without needing to bring 200 grand to the table. And so what Quest 7, so anyone who's in Quest 7, we basically have through the end of the month, if you either have made your, said that you're going to put that money in, or if not, you still have time. Karen, sorry for creating extra paperwork, but you still have time to let Karen know that you want to put more into that. And then at that point, all it has to be is an even multiple of 20,000. So you guys just can work that one out and you can come in. Otherwise, other people can message me separately if they would like to come in on that one. Next one, like I said, to the far other side of the to the far side of the risk spectrum would be Finanical. This is the medical device that is meant to service the fibromyalgia market and migraines, and as well as we talked about this. You got endometriosis, interstitial cystitis, and irritable bowel syndrome, and maybe even some long-term COVID. So Isaac is getting ready to head down to Belize for a work trip to go down there and meet with the doctor and also check out our other property, which, there's a little plug there. We've got another one coming down the pipeline for you guys, maybe later this year or early next year. But he's going to be heading down there and meeting with the founder of this company. We have been meeting with a few different potential partners to really help take this thing full circle. I think of them from a construction standpoint as more of a general contractor. That they have all of the different components, from the legal, the engineering, all of different pieces that need to combine to get this through FDA approval. So we're meeting with them. We're also looking at the different ways that we can do this as efficient as possible for the company. Isaac, anything you want to share on that one?
No, I can tell you that the only reason we took this on is because there's 21 million patients who suffer from fibromyalgia, and it is the number one linked disease to depression and suicide. And if you know much about my backstory, I have had a long-term, free from it now, but a long-term fight with depression and suicidal ideation. And so this speaks very closely to my heart, both from a philanthropic standpoint, but the math there is 21 million patients times $500. I don't think there's too much more else that needs to be said there. So this is a huge margin opportunity that could be. This is an opportunity to make 50 times your money. It is very speculative, and I will leave it at that. Very, very speculative.
Yeah, and obviously near and dear to a lot of the people in the BDC nation too, because of the patients that they deal with on a regular basis. Chiropractors are really the main point of care and hope for these patients. So anyways, more will come on that as we get into some additional testing, as we get through some other pieces. We'll keep you guys updated, especially those who haven't invested into this. Minimum investment on that one is 25,000. We are getting fairly far down the road with legal, and in which case then we'll be able to start taking money in. But we still got a little time before we're going to actually start taking those funds in. We talked a little bit about. This is the last one here, and then we'll wrap up and then hit some more questions. Also, the crypto hedge fund. Wanted to let you guys know what's going on inside of that. So, again, from an alternative investment standpoint, cryptocurrency, highly risky, highly speculative. The hedge fund is a vehicle to control the risk that you take on inside that, and you have a lot of volatility even inside that, with as much effort as we were putting on to controlling the risk. But inside that here, just recently, I think it had been June, the market was down 40% on the month, and we were up 2.5%, able to control the risk there. The next month, the market's up roughly 20%, and we're up 11%. There's so much that goes in behind this of this, but you got a strategy that has a lot of volatility inside of it that over time, statistically speaking, should come out significantly further ahead. And so that's where we're at inside that one. We have put a new trading strategy in place as of the middle of June and have seen tremendous results on that since then. But still, it's a very volatile market where we are trying to. It's a certainly believe that with everything going on inside inflation, everything that obviously you hear in the news what's going on with what the Fed's saying, and you get a piece of this. If you look under the hood at all of what we can do with interest rates and what our deficit spending is, like, the inflation monster is not going away. That is going to continue to grow, and raising interest rates does not fix that, because we still spend so much money as a government, and we are pumping so much money into the economy that just raising inflation, to cripple the economy does not fix what's happening inside inflation right now, because government spending is such a big piece of that. So anyways, crypto, we would certainly that is an option long term, but the hedge fund is really meant to profit, whether it goes to $1 million or whether it goes to 1,000. That we are trying to profit on the volatility, regardless of where you stand on crypto long term. I think with that, so just the idea being, like, the world of alternative investments is out there. Another, just for what Shawn and Lacey have done for the group here to bring you guys access to this, really can't be overstated. Most people have no idea that this stuff exists. Most financial advisors don't know that this exists. When I talk to financial advisors all the time, they're blown away by the stuff that we're doing, and then they talk about how their firm would never let them do that. And so just props to Shawn and Lacey for what they're doing here. With that, the next thing that I wanted to talk about, and we are going to get to the money wheel. So I know we talked about that, we're losing a couple of people, but we are going to get to the money wheel here. Shawn and Lacey have their, what's that?
As I say, we better hit it. We're at an hour.
All right, we'll hit that. So before we do that, August 29th through September 2nd, Shawn and Lacey have their the last 5 moves challenge. So please look into that. Get the details on that one. There we go. Thank you, James. You're all over it. So join the challenge there and see what you can do to really grow the business. Again, I have no problem plugging Shawn and Lacey, because every one of you know that they bring it with anything that they put out there. James, let's hit it, man.
What's going on? Thank you guys so much. I just got so much wiser and smarter when it comes to investments, and I think if I had a morning drive, I would definitely tune in to Eric and Isaac every morning.
I don't think we'll do that show, but sounds good.
The morning drive with Eric and Isaac. I appreciate you guys sharing your expertise, answering questions inside of this live stream, inside the group. Ton of good information, and people really loved it. But as promised, tonight we're giving away $300, and we're going to be drawing up to 3 names tonight. So the last time I was running the Money Monday show, I was feeling pretty good that someone was going to win, and I have that same feeling tonight. So, but before we get to that, everybody let Eric and Isaac know how much you've appreciated and how awesome they did by smashing the like button right there on YouTube. Smash the like button, as they say. Let them know how much you really appreciated their time and their expertise, and obviously they are serving people inside of this community like no other. So I just want them to receive all of the appreciation that they deserve. So smash that like button while we get into some drawing. So there we go. Everybody's loving it. So let's start with you guys still want to take some questions, right? I know we're coming up on an hour, but if you have a few questions you want to take. Okay.
There's a few in there I'd like to clarify for sure.
Okay, perfect. So let's do one name to start, and then we'll see where we go with that. All right. So let me get our timer here. Timer ready. We've got Kevin Clark. Kevin Clark, you got 30 seconds to show that you are here on the live stream. All you got to do is say, I'm here. 30 seconds. Here we go.
Come on, Kevin.
Let's go, Kevin. Kevin Clark.
This is intense. See. I didn't know it was going to be this intense.
Oh, yeah.
You got 30 seconds to show up, Kevin. All you got to do is say I'm here.
Sorry.
Come on,
Kevin
buddy.
Johnson's here, but we need Kevin Clark. Where we at? 3, 2, 1.
Oh, you spelled Jennifer wrong, James.
Oh, man. I'm sorry, Jen. I spelled your name wrong. So we got 2 more names, but let's take a couple questions. You guys, if you saw one earlier that you want to get back to, feel free to answer that, and then we'll draw another name.
All right.
Yeah,
Isaac,
so
we're getting quite a bit. Go ahead.
Let me clarify on the cash flow for how these deals normally work. So there's 2 things that you should be thinking about. You should be thinking about your monthly cash flow, certainly, which is fine, and then thinking about your overall internal rate of return, which is your rate of return discounted back to the day that you made the investment. So what are you making compounded from the day that you made the investment over the life of it? So typically these start out paying between 5 and 6% a year for the first year because they're paying immediately. And then as they effectuate their business plan over the 18 to 24 months, that cash flow steadily ramps up. And it generally gets to being around 8% by the time that they return all of your money back to you. So you're going to be making around 8%. They'll get you all of your money back. And then at that point, your return is infinite because remember, you're keeping your equity and you're continuing to get paid on your equity in the deal for the life of the deal. So internal rate of return, San Antonio is set up to return you between 16 and 19% per year. That's what's on the pro forma. And one of the things we love about REM, as I said earlier, is that they almost always, in fact, every time I've ever seen it, I say almost always to disclaim it, but I've never seen them not do this. They always outperform. So the recent deal that they actually sold, they were about 25, 26% to the LPs in their annual return. So you should think about this. Yes, the cash flow up front is nice, but how quickly are you getting your money back? How safe is your money? And then ultimately, how much do you make once you have all your money back? How much equity do you have to continue making it into perpetuity? So 16 to 19% return is what you should be expecting on this deal. And that would be a conservative equity estimate. Now, I should also caveat that does not count the tax advantages. So any tax advantages that you get in this, which are significant, those dramatically affect your real rate of return, which is not shown on the pro forma. That's just an added benefit. So if you have active status and you're getting 60% of your investment written off right up front, you're getting about another 20% roughly on of income of return on that. So it's a huge portion of this, not to be forgotten, but that is not factored in the 16 to 19% IRR. I hope that answered the question.
Perfect.
All right, James, let's hit another name.
Let's hit another name. All right. We got 2 more. I'm going to go pretty deep in here this time. Let's see. I'm way in the back, the bottom of the drum. All right, here we go. Let's see. All right. 30 seconds on the clock for Jonathan Guyman.
All right.
Here we go. 30 seconds. Here we go.
All right, Jonathan.
He's active in the group. I think he's been on one of the Money Mondays before. I see him comment every now and then. So maybe he's on here tonight. $300 tonight.
I wonder what the hit rate is on what's the success rate of catching people here.
We've had winners. We've had winners most weeks, I would say.
I know.
More than half, but you got to be on live. Oh, no.
Another chance for someone else. Another chance for a couple more questions.
Yes.
There's a great one in there from Anita. It's a great question I think we should address if you're good with it, Eric.
Yep.
Yeah. So Anita's question is, how does the limited partner money get used? That is the exact right question to ask. How's my money being used? It's used for 2 things and 2 things only. One, for a down payment on the deal to make sure you can get into it. They lever very conservatively. So they'll only use 60 to 70% leverage, which means that there's a lot of in the deals. It's for a very specific reason. It's because they want to make sure they're not over leveraged into a deal. That's the first thing. And the second thing, and I forgot to touch on this earlier, so I'm so glad Anita asked this, is they use the money for renovations Did you guys lose me?
We got you.
We got you.
Okay. Sorry, it just cut out and couldn't hear myself. They use the money for renovations, and so every one of these business plans, there's value add to be had. So they're going in and renovating every. And in this case, they are completely vertically integrated, and so they are their own GC, they're their own property management, they're their own acquisitions, et cetera, et cetera, et cetera. So they don't hire anybody; it's all in-house. And so they'll go in, and their budget on this property is they spend between $5,000 and $6,000 per unit. I will tell you, if I went and did the exact same deal, I would be spending $11,000 to $12,000 per unit. They have a 50% above me. They have a 50% advantage right away from other people that I've seen because they're incredibly efficient. They buy in huge quantities and they know exactly what they're doing. They do all their work internally. So Anita, great question. The money is used for down payment and it is used for renovation, very simply. And of course, working capital as well.
Perfect.
All right. Thank you, Isaac.
Great answer. Great answer. We ready for number 3?
Before we do that, I said I was going to put a little plug in here for what's coming down the pipeline.
Okay. Here we go.
Share my screens quick. Sorry, it's bulky and doesn't quite work that great, but we're going to just bear with us here.
Let's see. Let me add this in here.
All right, James. Tell me. There we go. So this is the project that this is the reason that Isaac is working in Belize, or one of the reasons. Isaac actually has a few properties in Belize, but we have acquired a piece of property in Belize that is, we are doing a ground up renovation. So this is off the coast of Belize here. And so it's a man-made island, or a man-made peninsula off an island off the coast of Belize. And so we have this property that is going to be putting in all of these different short-term rental opportunities here. So you've got this beautiful renderings of what's going on, literally right up to the canal, which puts you right out to the Caribbean. So just this gorgeous opportunity that we have coming here down the pipeline later this year. So if you want to be a part of that, or if you want to go rent this out later for, let's say, a Quest 7 mastermind group, then you let us know and we will make that happen. All right,
you guys are the first. You guys are the first people to ever see this. I told Eric he couldn't show it, so we'll argue about that later.
Yep.
I just want to try to prove. Yeah, I just want to try to prove somebody wrong. I'm going to go with Anand Sharma. I think I can pronounce your name.
I think that is how you pronounce it. Yeah.
Anand Sharma. I have a good friend named Anand, so I'm kind of cheating.
Verdict is, we'll wait and see. Maybe that's who James is going to draw here next.
Yeah, that might be. All right, are we ready for number 3, the last one of the night?
There you go.
All right, let's
come on, Anand. Anand Sharma.
One more spin tonight for $300. I'm feeling good about this one, guys. All right, let's see what we got. Uh-oh. Let's see. Let me get my timer up here. Jillian Farrell. Jillian, right. Are you on? Timer starts right now.
Sorry,
Let's
Paul.
see if Jillian's on. People are going to be texting her, messaging her. Better be on Money Mondays live. The morning drive with Eric and Isaac giving away $300. 10 seconds left. 5, 4, 3.
I think we went over tonight.
1. Oh, no. Well, you guys gave away so much value. The money drum was like, look, we can't give away any money tonight. They were like, nope, you guys gave away too much value. But next week absolutely. Next week we'll be up to $400, and Shawn and Lacey will be back in full effect. Did you guys want to take any more questions?
I'll keep taking them if people want to keep asking. Yeah, happy to.
Dug through most of them. I think there was a question a while back of who pays for the cost seg study.
The general partner. Yeah, it's all. And then Anita also asked where the money was held. So what happens is there's a new entity that's formed for the property and for the general and limited partners. This is all done on a Reg D 506C filed with the SEC and the carve out. So all the money is held by the property. It's a combination of the GPs and the LPs. So essentially, you own a portion of the company, the entity that owns the money. The cost seg is just paid out of the general funds that are used. So it's a relatively small portion of the overall deal.
Yep.
So it's usually 10 to 15K on a property like this.
Then I guess two other questions here. So Phil had asked, did you say the cap rate was 4.5%?
I'm using that as a representative number. So if you look at somewhere like San Antonio, generally these are going to be 4 to 5 cap properties. I use that as a multiplier just to show what a well-managed, optimized, sort of larger institutional type asset like this would sell for. And 4.5 is a rough estimate of what it could be, anywhere from 4 to 5. But I think 4.5 is probably pretty close. The critical thing to understand here is that the going in cap rate is one thing, but it's what's the stabilized cap rate after you've optimized management and done your value add. And that's where when you've got $500 or $600 a door upside, you're going to like come close to doubling your overall cap rate on net operating income. So most of their deals, they're looking at between a 50 and 100% increase in the net operating income, which means that you could be potentially doubling your stabilized cap rate. So lots of mumbo jumbo there. All it is to say is you want to be able to add value. You want to be able to increase your net operating income. And that's where all of the, really all of the wealth is found. That's where the capital gains are found.
Yeah. And Casey, yeah, got your question there. Yeah, that does include the renovations. So
critical question follow-up from Casey. Yes, everything is funded up front. And side note, the LPs here cannot be called for capital. So that is a critical thing. If there is capital that's needed, the GPs are required to put that in. So quite literally, your risk is only what you put in up front, and everything else is on the general partner to make the financial obligations whole. That's a great question, Casey.
And so on that note, important to recognize that if you go look at your own deal right now, so you heard Isaac talk about this, and you say, hey, I found a deal that's got says it's got this cap rate and this split afterward. That does not necessarily mean, or this pref, excuse me, if it's talking about this, like that does not necessarily mean the same thing across the board. And so important to make sure that if you are looking at some of these deals and you are not seasoned, I mean, Isaac's told me before he's got 20,000 hours in this and basically has a PhD level education inside these type of deals. And when you talk to him, you understand that he's not exaggerating. That's just important to understand that there's so much depth that goes into deciding if a deal is a good deal or not, which is why he's basically says no to 99% of them. Then as Shawn talked about, a lot of stuff that comes across is going to be a no. If the question is, would we do this with our own money? And so a lot of those are no. So anything that we're bringing to you, just understand that it's past the test. There doesn't mean that you should do everything that we are doing. Doesn't mean that we would expect that out of you or recommend that, but we're putting a pretty strict test on that before we would ever actually go into a deal or bring something to someone else. But good questions. Just make sure you understand that just because you heard, saw that it has a good pref rate or something else like that doesn't necessarily mean that the deal is actually going to work. Doesn't mean that the operator is going to turn a profit on this in the first place. And so a lot of risk out there inside real estate, especially right now.
That's a great point, Eric. The point is that what you see on the paper, the deal terms, they mean almost nothing. The value is in the operator and their ability to source deals at the right price. That's a great point. What you see on paper means almost nothing unless you know way more in depth about what's happening.
Yeah. Okay. Jonathan had asked about the is there room in Moon Gloves? And so yes, there is still room in Moon Gloves. So that is one that I had let the group know that we had an investor who was planning on taking down the whole thing, and we basically down to hey, you got to let us know within the next few days. That did not happen. We have a ton of interest around this and a lot of good things coming, but at the same time, we still have room in that investment at this point.
Makeup of the units. Anita, that's a good question. Let me pull that up. I think it's pretty close to 50-50 being 1-1 and 2-1s. Anita, actually, let me follow up with you on that one. I'm afraid if I open up this huge PDF, I'm going to lose my feed. So I'll follow up with you on that.
So R3 Chattanooga had asked, how do we stay apprised of the opportunities? Obviously, Quest 7. Yeah, whoever threw that out there, Quest 7, that's definitely your best option to stay involved, because there are a lot of opportunities that don't come from us. Shawn brings a lot of these to the table from other people besides just us. So joining Quest 7 is by far the best opportunity to get in front of this. But if you wanted to get a hold of, be in our investor database as well for not as many opportunities as what Shawn's going to bring to the table, but still some of them, then you can reach out to us separately. James, I don't know if you're able to just throw up our contact information.
Sure, I could type it in the chat or.
Okay. Either one of us are fine. If you talk to one of us, it's like talking to both of us at this point.
And what I could do, I'll put your contact information in the chat, and then also in the description of this video. So for anyone who comes back to watch this, they'll be able to get your contact information from on YouTube.
Sounds good.
I'm throwing it out there too. Isaac at peoplebrand.com.
That's the one.
Okay. Emails are also there if you want to let us know. All right.
Thank you guys so much for doing this. Just want to extend gratitude and appreciation from Shawn and Lacey down in Mexico. Huge help being able to keep this Money Mondays going on. And you were the first guest that we had on this live stream. So I think folks really enjoyed that. So, of course, I learned a ton, and I could tell everyone watching enjoyed it as well. So next week we will have $400 in 4 names, but you guys got a ton of value tonight, worth more than the 300 we were looking to give away tonight. So thank you again, Eric and Isaac. You guys were awesome.
You guys are very welcome.
Guys. And so much fun.
Yep. Big thanks to Shawn and Lacey for everything you guys are doing in Mexico City. Hope that continues to go well, guys.
Take care.
Everybody have a good night, and we'll see you next Monday.